Good day, fellow investors. Let's discuss stocks. What has changed over the last week with a 20% market crash? I have updated also the intrinsic table, so you can download that if you want with the updated values. And let's immediately start discussing our quadrant. Then we'll also add Apple, Starbucks, Nike, and perhaps also something else from the quadrant. Let's start with Petrolero Brasileiro. And you can see here, as oil prices tumbled, also the stock tumbled from 14 just a week ago to now 12. Dividend yield 21-22%, P ratio 12. However, we have to look at this from a cash generation perspective, and you can see here that their projections were made on 2025 barrel 83. The price of oil now is at 60, far from 83. And if we have a recession, more pumping, more drilling, then oil prices might become lower. And you can see here how $10 a barrel takes away about 5 billion of free cash flows from the company. So from 83 to 63, some lower taxes, things like that, and you have already 10 billion off from the company. 10 billion on the market cap of 73 billion, that is likely the projected dividend of 13% that they have been announcing for the next 5 years, and therefore you might expect a dividend cut. It is possible if oil prices persist on the lower, which means this then is valued completely different. Yes, they say that their break-even Brent is 28, capex break-even, which means sustained production and everything, at 45, but there is still the debt pile, things like that, interest rates, so still risky. And that is also shown in the stock price, and that is also shown here with, let's say, average oil prices, 13% yield, but risk high because of that sensitivity to oil prices. And we'll also touch on Occidental a little bit later. The next one on the quadrant was ASML. This is insane. So the darling of the markets just last year, the company that nothing can touch it, no price is too high, is down 45%. Market cap down from 450 to 225, P ratio below 30, and a small dividend yield. However, if we look at their long-term projections, now, semiconductor growth is expected at 9% per year over the next 5 years. That is the future, AI and things like that. And here it comes the cyclicality of investing. Maybe we'll see a recession, things like that, and maybe the growth will be postponed by a year or two. So maybe we'll see a decline and then growth again. That is the risk and reward of the situation, and that is also what the market is reacting here. The market doesn't think long term, and they always react on short term ups and downs. However, we as investors have to look at long term. So they expect sales between 44 and 60 billion by 2030. Let's take the worst case scenario, 44 billion. If we look at their margins that are expected to be significant over time, let's say that on 40 billion, they make 20 billion in earnings, 20 billion, compare that to the market cap. I don't think that the P ratio will be 11 in 2030 in the worst case scenario. Best case scenario, they make 30 billion in that year, which means the P ratio would be what? 8. 8 for ASML long term, unlikely. And that is the risk and reward. Yes, in the short term it can go even lower, which just improves the long term situation. But yes, in the short term it can go much lower, especially if this happens. So we are now here, and then for a year or two investments pause and things like that, and then only, I don't know, in 2028 we start going high. If this happens, then we can see a P ratio of 15, lower sales on things where we are now, and that would mean still 30-40% down. So I have left here ASML from a risk and reward perspective, still likely to give you a long-term good return, but risky. And I need to know more about the segment to really stick my hand into the water, but this is the current risk and reward. Next one on the list, Archer-Daniels-Midland. You can see here it's my favorite, as I have put it on the lower risk side with a good return when you look it from low reward to high reward and from low risk to high risk. If we look at the situation, the stock is down 10% over the last few days. The dividend yield went from 4% to 4.75%, 51 years of dividend increases. If I look at food prices, then we are here, and I see also an increase during the first 3 months of this year. They have discussed how they will be positively and negatively impacted by tariffs, and we have to see how will they manage that over time. But there is a lot of uncertainty. The market doesn't like uncertainty, but I have one certainty when it comes to food. You are likely going to eat today, tomorrow, maybe you do some intermittent fasting here and there, I should do a little bit more, but it will not impact ADM over the long term. Plus, they own Asia, they own 22% of the Asian counterpart that has just bought India. So there is 10 billion people expected in the future, food infrastructure. It's hard, despite tariffs, to see that go down very badly. I'll put here the card to the link of the deep analysis that we have made. I'll leave it here because I still think now we are there on the 10-ish% long-term return, 4% dividend, 5% dividend, 4-5% growth, and then on the cycle we make a little bit more money. But I hope to see, as I always said, I hope to see it in the 30s, which would make it, okay, this is now something really, really interesting, and perhaps Trump will give me that gift if he continues with his act. The next one, just recently analyzed, BHP Group. All the links to the analysis will be in the description below. We see now a very low P/E ratio, but when we look at BHP, if there is a recession, copper prices are just back to where those were before the pre-tariff rush to purchase. This was price increases because of the rush to buy before tariffs, and now that is back to, let's say, normality. But we are still far from recession lows if we look at copper prices. The cost of production marginal is still 2.5, 2.75. So in a recession, in a global slowdown, I would expect copper to be below 3. Then also, if we look at iron ore, the long-term supply and demand leads to lower iron ore prices, let's say 80, if we have a recession, global slowdown, 70, and that would mean that these numbers would get cancelled here on BHP, and that also explains this downturn. So yes, it looks already interesting, as we discussed in the video. If you want to start a position and then increase the position as it goes down, sooner or later, because of the quality of the assets, it will rebound, but it is impossible to predict when. So I have left it here, good long-term likely return, but as I say, long-term, short-term, it's negative, and that is why the people are selling. Another cyclical, in this case Occidental Petroleum, 21% down over the last few days. The free cash flows we calculated in the analysis were 5 billion, so now we are at a significantly positive long-term average free cash flow discussion, but we must keep in mind oil prices are down from 80 to 60. If we look at the sensitivities, 240 million per $1 barrel change. If barrel change $10, that is 2.5 billion. add a little bit from midstream and marketing, from OxyChem, and there goes the 5 billion in free cash flow that Occidental has in a normal environment. And yes, they have break-even minus 50, but they are on top of everything. This is what you look for. They are break-even minus 60 going forward. If oil prices are 60, there is no cash flow, no free cash flow, which means they will have to postpone their debt repayments, postpone dividend payments, postpone buybacks, and this is why also there is selling pressure, because when everything is postponed, you discount to a further date in time, and that is why the stock is low. However, if on average, and they come back to the 5 billion of free cash flow, this is then what, a 13% free cash flow yield, and therefore I have pushed Occidental from here to a higher possible return, but also increased a little bit the risk because of the tariff surprise that was higher and might impact global economic growth and therefore long-term oil prices, on top of the OPEC announcement of more pumping. Similar situation with a recession. Chemicals without any competitive advantage are hit severely. You can see here the Dow really bad over the last few years. The dividend yield went from 7% when we analyzed it to 10% now, and that will likely be cut when they make no money this year on lower prices for commodities. And when it comes to cyclicals, you have to first think, okay, it's easier to predict an upturn than a downturn. Then when you're looking at it, look at the inventories. If inventories are piling up, if they have problems selling, if prices taken from the market are lower, then you know we are still in trouble. The next phase is they need to start putting plans on care and maintenance so that they lower the supply in the market. That means that when still they are paying the dividend, it can always get worse, so you need to watch for those dividend cuts. And now we have a recession ahead. If it lasts a year, 2 years, as it might happen, then it will really look ugly. Might not happen, so again, as I said, have a strategy. You can have a position if you want. If it does not happen, if everything gets well in world, you get a 10% yield. However, if it happens, you must expect 50% down. Yes, it is how it is with cyclicals. Now, let's discuss Amazon. The stock is down, but just 10% over the last week, 16%, 14% over the last month or something. However, if I look at the long-term chart, we are still up 100% over the last 3 years. So this is still nothing. This is still no market shock. This is no tectonic shift. This is just back to where we were 6 months ago. So nothing spectacular there. And I don't have to change its position of a great business, but still relatively pricey on my quadrant. Let's discuss Verizon. So we have a dividend yield that's switching between 5 and 6 and 7, and now the stock is down a little bit as likely the market expects a recession, thus less business for Verizon, but still also lower interest rates, lower debt payments, so should be stability for Verizon, 6% yield, and then depending on the market, how they like it or they don't like it, you can trade a little bit around. But for now, stable, therefore it stays here on the quadrant for a 6% long-term return. Schwab equity, I have put it here on 4 or 5%, and now that risk is materializing because they always push for those dividend yielding stocks. Those dividend yielding stocks, as we have discussed with Dow, will likely have to cut their dividends, and that is why you see this drop in dividends and stock prices. So that is something that is the risk. When was this launched? In 2014, so they haven't really seen a big dividend crash. So I'll leave it here. Long term will likely be dividend plus some percentage point of growth. If we discuss the S&P 500, my intrinsic value calculation is 3,000. if we just show here, it is just where it was a few months ago, nothing much to add there, still far from the 3,000 intrinsic value. What's left? My favorite business out there, Berkshire, but still, Berkshire is again where it was a month ago. Many get confused here. They see this P ratio from Google of 11, 12, but that includes the accounting of stock price increases versus just operating earnings that Warren Buffett calculates. Calculate 40 billion of value creation from Berkshire, and then you have here a P ratio of 25. Maybe 45 billion, and then you have a P ratio of 20 something. But this is the P ratio. Historical range is 10 to 20. So you're buying Berkshire on the expensive side. We made this video on Berkshire, detailed analysis, the risk and reward. If you haven't watched it, watch this if you want to know the details on investing in Berkshire. But for me, it is too expensive. Now, a stock that we have discussed in the past when it was always too expensive for me, and some people said Nike will never be at 50, and look at this, it is at 50. If we look at the last earnings, we are down 9%, down 12%, everything is down, gross margins decreased down. This looks ugly, but their win now, it was innovation last year, so they are searching for something to get back on track. But Nike is still making money if you look at things. The P ratio is still there, the dividend is there, and yes, revenues are down a little bit when you look here up. Net income is down from 6 billion to 4.5 billion. If you look at the trend post-pandemic, across the pandemic boom, everything is growing. Buybacks also push earnings a little bit higher. Free cash flows are there, 5 billion. So it's still just a free cash flow yield of what? High single digits, so nothing stellar there. The P ratio has now normalized, and we have to see how will sales go across the board, China, things like that. And therefore, the globalization that benefited Nike over the last 20 years, 30 years, is now turning around. So I don't know how. Maybe they will be able to get a boom, but still, P ratio of 20, again, too much for me, too risky, I don't know. And all these fashion brands, some are so cheap, but you don't know what will the sales be 2 years from now, because it's all about consumer preferences. Now, Starbucks, this is crazy. Downgraded now from Wall Street. And where do they downgrade? They downgrade it here as the stock price crashes 30%. And then you look at what they are saying. Sell-side analysts spend their weekends ripping up their models and downgrading stocks across the board because of tariffs. But they are predicting now that tariffs will weigh on consumer confidence, thus unemployment, thus people getting fired, and increase the odds of a significant pullback in consumer spending, big recession, unemployment, less frappuccinos when you go to work, and Starbucks has already been negatively impacted a little bit. Yes, global store count is going up, but when I look at Starbucks, you have to understand that it did grow over the last 10 years significantly. Earnings per share a little bit less. They are still paying the dividend. They have cut the buybacks, which is something that puts pressure on the stock price because buybacks lift stock price significantly. But still, the P ratio is 25, and the thing is, wherever I turn around when I go somewhere, yes, there might be a Starbucks, but there are also 20 other competitors. So that is the problem. China also, when you open a shop, the next day someone opens a similar shop next to you. And for me, it's just too much of an unknown, even if it looks like a great business at a P ratio of 25 with a dividend yield of just 3%. Apple is down 30%, 181 price. My intrinsic value for a 10% return, which is the minimal we as investors should expect, is 105. So still plenty to go. We'll see how tariffs impact this, but for me, it's a no-go now. Now, if we look at this, this is the one I am considering. I'll now do an update on my research platform to compare to the others on the covered list. These are interesting, but you need to know more than I do about them on how those fit your portfolio and your financial goals. Thanks for watching. Check my research platform for all my transactions, portfolios, covered stocks, and own stocks. I'll see you in the next video.